Let's tackle the topic of student debt. What are the differences between student loans and other forms of debt? First, student loans are long-term debt. They are repaid over decades, while credit card and auto loans are repaid over months to years. Student loan debt outstanding exceeded credit card debt outstanding for the first time in 2010, auto loans in 2011, and reached the $1 trillion milestone in early 2012. Federal and private student loans are unsecured, while an auto loan is secured by the vehicle and a mortgage is secured by the home. If you default on a home equity loan or line of credit, you can lose the home. If you default on a student loan, the lender can't repossess your education. Most student loans allow the borrower to defer repayment while the borrower is enrolled in school. Most student loans allow the borrower to defer repayment on the student loans while the student is enrolled in school on at least a half-time basis and for 6 months after graduation. Home equity loans, mortgages, auto loans, and credit cards usually require that repayment begin immediately. Most federal and private student loans offer a slight interest rate reduction if you sign up for auto debit, where your monthly loan payments are direct debited from your checking account or other bank account. Home equity loans, mortgages, auto loans, and credit cards, and most other forms of consumer credit do not offer auto debit discounts. Federal and private student loans are almost impossible to discharge in bankruptcy. In the words of one bankruptcy judge, it requires a certainty of hopelessness. You are more likely to die in a car accident or of cancer than to get your student loans discharged in bankruptcy. In addition, federal education loans and some private student loans will cancel the debt if the student or the borrower dies or becomes totally and permanently disabled. Other types of debt do not do this. Other types of debt do not offer similar benefits. Up to $2,500 in student loan interest on both federal and private student loans may be deducted on your federal income tax return as an above-the-line exclusion from income. This means you can take this deduction even if you don't itemize. Home equity loans and lines of credit allow one to deduct the interest on up to $100,000 of debt if you itemize. Also note that the home equity interest deduction is subject to the alternative minimum tax, so you might not get the full benefit of this deduction, if at all. Now, what are some of the differences between federal and private student loans? Federal education loans have fixed interest rates that will not change for the life of the loan. If you get a Stafford loan at 6.8%, it will always be at 6.8%. This yields a predictable monthly loan payment. Most private student loans, especially the non-government loans, have variable interest rates, which may change on a monthly or quarterly basis. Since the variable interest rates are currently at historic lows, there is nowhere for the variable rate to go but up. Interest rates on variable rate loans are likely to increase by as much as 6 percentage points or more. Now, there are some private student loans with fixed interest rates, mostly state loans, although a few private lenders have started offering fixed rate options on their private student loans. Some private lenders have started offering, let me start again. Some state lenders offer fixed rate loans, and some private student loan lenders offer fixed rate options on their private student loans. But most private student loans these days still have variable interest rates. Eligibility for federal student loans, such as the Federal Stafford and Federal Perkins loan, is not based on the credit history of the borrower. Most private student loans, on the other hand, are credit underwritten. If you have bad credit, you won't be able to get a private student loan. You also won't be able to get a credit card, auto loan, or mortgage. The interest rates and fees on private student loans also depend on your credit scores. The higher the credit score, the lower the interest rate. Federal education loans do not require cosigners. More than 90% of new private student loans, however, require a credit-worthy cosigner. Most traditional college students, straight out of high school, are going to have a thin or non-existent credit history. If they happen to have a credit history, it's usually a bad one. So a traditional high school student transitioning into college probably isn't going to be able to qualify for a private student loan on their own. They will need to have a credit-worthy cosigner. And even if the student has a good credit, it can be beneficial to have a cosigner because the interest rate that you pay is based on the higher of the two credit scores. So a cosigner could reduce your interest rate. But the cosigners need to recognize that a cosigner is a co-borrower, equally obligated to repay the debt. The private student loan is going to appear on the credit history not just of the borrower, but also that of the cosigner. So if that cosigner wants to refinance a mortgage, the mortgage lender is going to look at the credit history and see that they've cosigned on a private student loan. The cosigner say, but that isn't my loan. The lender will say, doesn't matter. You're a co-borrower on that loan. If the primary borrower stops paying, you're going to have to start paying. And it can also ruin your credit history because you're essentially linking your credit history to that of the borrower of that loan. If the primary borrower, the student, is delinquent, is late with a payment, or even defaults on a loan, it's not only going to ruin that student's credit history, it's going to ruin the credit history of the cosigner. So it's a kind of risky to co-sign on a student loan, or any loan for that matter. Now, if you run into financial difficulty, the federal education loans offer more options for financial relief than the private student loans. They offer deferments and forbearances that temporarily suspend the obligation to repay the debt. For example, the economic hardship deferment is for up to 3 years, and forbearances, including one for unemployment, is for up to 5 years. Whereas the private student loans, if they offer a forbearance, it's usually limited to no more than a year in total duration. And they may even charge you a quarterly fee in addition to the interest that's accruing for the benefit of having that forbearance. So you end up in a deeper hole than when you started. Now, the federal government does pay the interest on subsidized Stafford loans and Perkins loans while the student is in school or during the economic hardship deferment. The government does not pay the interest on these loans during a forbearance, and does not pay the interest on unsubsidized loans during either a deferment or forbearance. Another difference between federal and private student loans is that federal student loans offer income-based repayment and public service loan forgiveness. Most private student loans do not. Also, the federal Parent Plus loan, which is borrowed by parents on behalf of their undergraduate student children, is not eligible for income-based repayment. Also, the Federal Plus loan, which is borrowed by parents of dependent undergraduate students to pay for their education, is not eligible for income-based repayment or public service loan forgiveness. Federal student loans also offer flexible repayment terms, such as graduated repayment and extended repayment, in addition to income-based repayment. If you default on the loans, the federal government has much stronger powers to force you to repay the loan than private student loan lenders do. For example, the federal government can garnish your wages up to 15%, and they can intercept your federal and state income tax refunds, as well as any state lottery winnings. And they can do this without a court order. For a private lender to do this, to garnish your wages, they have to get a judgment against you, and then the judge has to order wage garnishment. In addition, the loans don't disappear when you retire. The federal government can garnish up to 15% of your Social Security, disability, and retirement benefits. And it's going to cost you to default on the loan, because every payment whether it's voluntary or involuntary, is going to have up to 20% deducted for collection charges to reimburse the government for the cost of collecting your defaulted loan. Now, these aren't the actual costs. This is the average across all defaulted borrowers. So you're not only paying for the cost of repaying your loans, but also the loans of borrowers who never pay. Doesn't seem fair, does it? But unfortunately, if you default on your loans, you're going to have to pay these charges. And what this means is that the collection charges are cut off the top, then the payments are applied to the interest, and only that after you've paid the interest will the remaining payment be applied to the principal balance of the loan. This significantly slows the repayment trajectory of the loan, making a 10-year loan take 19 years to pay back at the same monthly payment. In addition, the federal government can block renewal of a professional license. If you default on a federal education loan, you can't enlist in the military, and you will not be eligible for an FHA or VA mortgage. There are no statutes of limitation on federal education loans. The only end to these loans is when the borrower dies, the remaining debt is canceled. Federal student loans, except for the PLUS loan, have lower loan limits than private student loans. But that may not be such a bad thing, because it forces you to borrow less. You don't want to borrow too much. If you find yourself needing to borrow from a private student loan or the Parent PLUS loan, it may be a sign that you're overborrowing for your education. A good rule of thumb is that your total student loan debt at graduation should be less than your annual starting salary. If your total debt is less than your annual income, you'll be able to pay back the loans in 10 years or less. If your total debt exceeds your annual income, you're going to struggle to make your loan payments, and you'll need an alternate repayment plan like income-based repayment or extended repayment in order to afford the monthly loan payments on your loans. And that means you'll still be paying back your own student loans when your children enroll in college. Hardly a good situation. It means you'll be less likely to have saved for their college education, you'll be less willing to borrow to help them pay for their college education, so the debt burden on the next generation will be that much greater.